What's up everyone, it's Connie with MoneyVest. So in this video, we are going to craft a path for Microsoft getting up to almost $5 trillion market cap, because there was a huge catalyst that was announced recently that Microsoft and OpenAI together are planning to build a $100 billion data center project. Yes, that is correct, $100 billion. That is quite a significant number. That's 10% of $1 trillion worth of data centers being built around artificial intelligence. There's going to be a lot of involvement of chips, semiconductors, and AIs. Again, Microsoft is now the biggest company in the world, publicly traded, worth well over $3 trillion for the company. So again, the market cap is quite large for this organization. And of course, it has eclipsed Apple. Again, every company that's kind of come in its path, it's one of the most successful and most profitable and consistently stable businesses. Not only is it sticky, but it's also a fantastic product and service company here in the United States and of course in the world, because we use Microsoft's products and services almost every day. So in this video, we're going to talk a little bit about the catalyst here. As always, if you enjoyed, find it helpful, make sure that you drop a like. I would really appreciate that. And links to our Discord and Patreon is going to be down below. There's about 2 more spots left if you're interested in joining us with that 16% annual discount available until the end of this month. So that discount is going to go away. And again, all the members, everybody who does join prior to our launch is going to get that pricing locked in for them forever. So that's going to be the promo pricing that's going to be locked in for the moneyvest.com platform forever. And again, once we do actually go public with the launch here, then of course the pricing is going to be different. So links going to be down below. Would love to have you on board, and you can do a complete fundamental analysis on a lot of different companies on the platform here. So this right here is going to be the catalyst here. Microsoft OpenAI plan to build a $100 billion data center project. And again, Microsoft and OpenAI are working on plans for a data center project that could cost as much as $100 billion and include artificial intelligence supercomputer called Stargate, set to launch in 2028. So in about 4 years from now, we're going to see a supercomputer, AI-driven supercomputer called Stargate, and OpenAI did not immediately respond, but rapid adoption of generative artificial intelligence technologies has led to skyrocketing demand for AI data centers capable of handling more advanced tasks than traditional data centers. And the information reported that Microsoft would likely finance a project which is expected to be 100 times more costly than some of the biggest existing data centers, citing people involved in the private conversations of the proposal as well. Now, of course, Microsoft Azure is going to be the one that's going to be potentially at the forefront of building this with OpenAI and data centers that, of course, a lot of companies are going to be using, and it's going to be a lot more efficient processes for companies. And right now, of course, there's competition between Amazon Web Services, Azure, and Google Cloud. And again, Azure kind of AWS being the top one, of course, with Azure being at the close second and Google Cloud being a third. Information attributed the tentative cost of $100 billion to a person who spoke to Altman about it, and a person who has viewed some of Microsoft's initial cost estimates. And Altman and Microsoft has spread the supercomputer across 5 phases, with Stargate as the 5th phase, and Microsoft is working on a smaller 4th phase supercomputer for OpenAI to be launched around 2026. And AI chips, of course, are going to be very, very important, because they are going to involve acquiring the needed AI chips. They're sold at a premium because NVIDIA is, of course, the leader in generative AI semiconductors, and their latest Blackwell B200 artificial intelligence chips will be priced between $30,000 and $40,000. Man, what am I doing making YouTube videos? I should really be making chips, semiconductors. We are always planning for the next generation of infrastructure innovations needed to continue pushing the frontier of AI capabilities. This right here is what was said by a Microsoft spokesperson, and expenses for the plan could exceed about $115 billion for the company, which was, again, more than the expenditures last year on capital spending on servers, buildings, and other equipments combined. This right here is the earnings. So Microsoft is going to be reporting earnings on April 23rd, actually. And the consensus EPS expectations for the quarter are $2.84. And last year it was at $2.45. So we're expecting for a slight increase in actual earnings per share and bottom line here. And what kind of growth is already priced in? If you take a look at where Microsoft is currently trading. So again, revenues, very nice growth. I mean, they've gone from 86 billion to well over 227 billion. Gross profit from 60 billion to 158 billion. Scroll down a little bit. If you take a look at net income, $22 billion to $82 billion. So again, a very, very profitable business here. And shares outstanding, of course, have gone down because of so much share buybacks for the company. If you come over to cash flow, so bottom line, levered free cash flow has gone from 23 billion to 58.68 billion dollars for the business here. And then of course we're looking at a very, very solid balance sheet. We don't have to go over it, but we do know cash more than the debt, balance sheet, current assets over current liabilities. So current ratio is also solid. And this right here is margins, 70% gross margins. We're looking at net margins over 36%, return on common equity 39, return on total capital 20%, and a return on total assets also at 17.5%. This is another really important metric, $373,000 profit per employee, which is a significant increase from $323,000 on a 5-year average basis. So that definitely means that companies becoming more efficient over time here. Now this right here is the valuation, which we have disagreed that valuation wise Microsoft's trading at a bit of a premium. PEG ratio right now, if you take a look at PE non-GAAP forward, we're looking at PEG non-GAAP forward 2.41. So on a growth adjusted basis, Microsoft is argued to be expensive right now, and a 38 times price earnings multiple, price to sales trading at over 12 to 13, and a price to cash flow at over 28 to 30 times cash flow at the moment. So of course we are looking at a company that is trading at a bit of a premium here at the moment. $11.69 is going to be that earnings per share estimate, which gives us a 4P ratio of just under 36, 19% growth, then 14%, 17, 17, 11, 10, 11, 11. So that's going to be roughly around 10 to 20% growth rate for Microsoft over the next 9 to 10 years, and growing earnings per share from $11.69 to $32.74 for the business as well. Now, when it comes to the total addressable market, which is a very, very important component when you are kind of looking at companies 10 years out, 20 years out, it's really important for us to understand how big could they possibly become. And all of that is dependent on how big is the market that they operate in. So global economy is currently pegged at around $100 trillion. And according to technology data firm Gartner, global IT spend is close to 5% of that. That's $4.5 trillion. Now, Microsoft CEO Satya Nadella said back in 2020, that's before all this AI buzz kicked off, that tech spending as a percentage of global economy is set to double over the next 10 years. So let's just assume for the moment that he's right. And if the global economy grows at 2.5% for 10 years, it'll be worth $128 trillion by 2033. And if IT spend were to roughly double 10%, it'd be a whopping $12.8 trillion. Now, with sales around $220 billion, that's roughly a rough estimate for the fiscal year, which ends in June. Microsoft commands around 5% of the current IT global spend. So let's just say the firm simply holds its current share of the gains no more. That equates to sales around $640 billion 10 years from now, and 190% higher than the current levels, and 11% a year is magically close to 10% a year that's currently priced in. So that only means 11% growth that is going to be accounted for Microsoft over the next 10 years, and growing revenues from $220 to $640 billion. And then if you come over to the profitability, right? So if you look at the profitability here, net margins sitting at well over 36%, so $660 billion. And if you do 660 billion, that's 660 billion, and that's 38% margins. If you multiply these two numbers, we're looking at net income of $250 billion. And if you simply apply a multiple of, let's say, 20, right, for Microsoft, we're looking at $5 trillion in market cap for Microsoft. So essentially what I'm trying to say here is that even at today's prices, $220 billion, right? Again, this is based on a multiple compression. If you apply a 38 times multiple, which is exactly where Microsoft's trading today, we're looking at over $9.5 trillion in market cap, which is quite insane. But if I go with a reasonable, more conservative estimate of 20 times earnings multiple for Microsoft over the next 10 years, where it's able to grow revenues by just 10%, only 10%, right? Because right now it's at 220 billion in revenue. So if you do the rate command here, 10 number of periods 10, payment per period 0, present value is going to be 220, future value is going to be 660. We're going to do that. Boom, boom, boom. That's about 12%. So if you do a little bit further here, we're looking at 11.61%. So meaning, if you do a reverse sort of analysis here, what this basically tells us is that if Microsoft is able to grow revenues, top line revenues, from 220 billion to 660 billion in the next 10 years, that's only an 11.6% growth in top line revenue, and command a 38% net margins, which is exactly where it is right now, right? Net margins actually 36%, so we can go a little bit lower, so 0.36, right? So 36% margin. Then it's going to be close to a $5 trillion market cap for Microsoft. We're also going to do a reverse discounted cash flow on a 7-year basis. So I'm going to come over here and I'm going to come over to Microsoft. In fact, actually, we could even do a 10-year discounted cash flow model for Microsoft. So MSFT, last trailing 12 months free cash flow. Let's just plug that number in. So we're going to come over here, cash flow wise, all the way at the bottom. We're looking at levered free cash flows of about 56,681. So 56,681. And then let's just do a very simple math here in terms of what needs to happen in order for Microsoft to validate today's numbers. So if you go with, let's say, 20% growth rate or 25%, 26%, there we go. So what that simply means is that based on today's market price of $420, Microsoft would need to hit a 26% growth in free cash flows for the next 10 years in order to justify today's intrinsic value. Now, because Microsoft actually does pay a dividend, right? So if you come over to MSFT, Microsoft pays about a 0.71% dividend. So we can maybe drop this down to 11%. That means dropping this number down to 24, 23%. There we go, 23.5% to be precise, where we need to be in order for Microsoft to justify today's intrinsic value, right? So $420, and only then there's going to be a potential for us to see, Microsoft from $427. Again, we're going to do a 12% over the next 10 years, and that's going to lead to a market cap of close to $5 trillion. Now, the question is, do you actually believe that Microsoft can grow 24% in terms of their cash flows? And the answer is most likely going to be no. I don't think that Microsoft can grow cash flows by over 24% over the next 10 years, regardless of how strong their market opportunity is, regardless of how big the market is. But 24% is still quite crazy if you think about it in terms of that free cash flow growth. So that's kind of like the analysis here, just trying to understand, based on a reverse discounted cash flow, what is going to be that appropriate number that Microsoft needs to hit in order to justify today's valuation. Now, if you come over to 10 years discounted earnings multiple model, so if you come over to the fair value of, based on the earnings, $86 billion last year, we know we grow the numbers by, let's say, 16%, 25 times P multiple, 12% discount rate, 10% margin of safety, and let's say minus 3% share buyback. And now we're looking at a fair value which is closer to $501 per share. If you go with slightly lower growth rate, which I think we should, because again, 16% is a little bit too high. If you grow with 12%, then we're looking at a fair value closer to $353 per share at a 25 times PE multiple for the business here. So basically what that means is that, okay, look, Microsoft right now, $220 billion in revenue. 660 is going to be about an 11.5% growth rate over the next 10 years. Very much achievable, along with the 36% net margins, profit margins, and we get down to a market cap of almost $4.7 trillion. But that is not going to be a market-beating return, and I'll tell you why. Because if you go with those same numbers, right, if you go with 11.5%, which is exactly what we went over earlier, so 11.5%, we give them a 20 times PE multiple, 12% discount rate. We can go a little bit lower, 11% discount rate, 10% margin of safety, and share buybacks of 3% here. Then we're looking at year 10 profitability, $255 billion, right? So that's exactly almost what we calculated, $237 billion. And if you come back to the 10-year DEM, the fair value is going to be just under $300 per share, so $295, and only then our actual growth rate is going to be significantly more than if you were to invest, let's say, today, and we're expecting for the price to get up to $932. Basically, what I'm trying to say is that the profit potential is going to be less at these prices than it is over, of course, waiting for a deal at sub $300 per share, because sub 300, so basically going from 295 to 932 is a 215% return versus going from 420 to 932. That's going to be just under, I think a little bit over 100% return for the company over 10 years, which over 10 years, could be less of a return, may not be a market beating return. But even then, again, really depends on how long you want to be invested for. Market cap for Microsoft most certainly has the highest potential of getting up to $5 trillion, considering that the global economy is growing, technology, the IT spend is also increasing rapidly. And for those reasons, Microsoft, of course, and Apple, along with, few other big tech companies have the highest chances or probabilities to getting up to that $5 trillion mark. So hope you all enjoyed this video. Me personally, I would be very much interested in absolutely loading the boat here at around $295, so sub $300 per share. This right here is going to be the entire technical analysis where, of course, we've got a very, very massive support inside this green rectangle along with this higher low, along with, again, 364 down to 349, as well as, of course, a very, very strong area of demand in the 300s and 292. So for me, this right here is most certainly going to be the best buying opportunity for Microsoft over the long term, over the next 10 years, with a potential for it to get up to over $900 per share. That's going to be their price target over 10 years, and that's going to be a return of well over 200% for the company over 10 years. So let me know your thoughts down in the comment section below. Again, if you enjoyed this video, find it helpful, make sure that you drop a like, subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining us. And as always, happy investing, and I'll see you all in the next video.